Hey, thanks for joining me for our November SWAN Report. This is Andrew McNair from SWAN Capital. In this month's video, we're going to discuss some recent headlines that influence the financial markets, but I also want to provide you some perspective on what these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, at SWAN Capital, our market outlook is caution. We are cautious about inflation as well as the Fed's monetary policy. But in lighter news, Mark Zuckerberg announced that Facebook will change its name to Meta and undergo a branding change. It's been reported that Zuckerberg is obsessed with the metaverse and a make-believe universe for gamers. Now, while the release of this new name sparked a really initial surge by as much as 25%, time will only tell. Is there going to be a real impact? See, Facebook has had a tough time lately, as well as other technology companies, but Congress has taken it to task over the revelations that the company knowingly put profits ahead of concerns regarding the harm of its platform that it may have caused to consumers and as well as children. It may have prompted this rebranding, or it may not have prompted this rebranding, but Facebook needed a facelift, and we're just not sure this is going to be it. Unless the company fundamentally shifts its direction, woes will follow Facebook no matter what it calls itself. So markets also didn't seem to blink at the weaker third quarter GDP reading or the spending agenda that delayed in Congress. The logic may have been that the slowing economic growth and potentially less spending from Washington could translate into lower inflation, which in turn could lead the Fed to hold off on tapering or raising interest rates. That seems to be somewhat of a stretch, but there's no explaining the recent upward movements of the market other than earnings being pretty strong. Strong earnings have mostly pushed the market to new records, and there really seems to be scant concern that anything is out of place, despite warning signs everywhere. Sometimes you have to wonder, is the market seeing the same things that you and I are seeing? When you look at the slowing economy, unfilled jobs, low job growth, inflation running at 30-year highs, lower consumer confidence, soaring government spending, you wonder, what is the market looking at? If you're comfortable with where things are right now, maybe you should sit just as you are. But remember that we haven't had a correction in the 10 to 20% range since the pandemic lows of March 2020. Corrections and volatility are going to happen, and the longer that we go without one, the more likely we're going to have worse volatility ahead. That said, it's also a good time to conduct an investment gut check. How would you feel if the market dropped 15%? And we're not saying it will, but it can be and should be a possibility that it could happen in the next 6 months. So you want to make sure you're ready, because if recent history is any indication, a market move will be swift and won't give you much time to react. Now let's turn our attention to the Fed. The headline pretty much says it all. Latest inflation reading hits largest level in 3 decades. Early November's CPI, or Consumer Price Index, actually showed prices jump 6.2% between October 2020 and October 2021. That's an outpacing of expectations of nearly 6%. Consumers are definitely taking notice. The largest increase since the September report were in food at nearly 1%, new vehicles at 1.4%, used vehicles at 2.5%, and energy nearing a 5% increase. See, a 6.2% jump not only increases prices, but it effectively wipes out the raise for Social Security beneficiaries and retirees. See, they're getting a 6% cost of living adjustment in 2022, the biggest since 1982. But that's not encouraging to Social Security recipients who are struggling to keep up with rising costs. So while ongoing issues at ports, inclement weather can take some of the blame, some economic experts are pointing the finger at the Federal Reserve's loose monetary policy as the primary catalyst for price hikes. And even the Fed has announced plans to taper its bond purchases. And this transitory inflation really begs the question, how long do rates need to stay unusually high for it not to be transitory or temporary no longer? So what's going to happen now? As mentioned before, the Fed has announced its plan to start tapering in an effort to reduce liquidity. But that's not scheduled to happen till early December. Not to mention, it will take 8 months to finish the tapering process. It may be a good idea for the Fed to add the discussion of speeding up the tapering timeline, or revisit potential raises in interest rates to its December meeting agenda. So one debatable news for this month is the labor market's results. Following 2 miserable monthly job reports, the October Bureau of Labor Statistics, or the BLS report, actually showed that it was better, but not gangbusters. The October number came in at 530,000 jobs, while the prior 2 months were revised upward, but nowhere near the 700,000 jobs that were estimated. October estimates were 450,000 jobs, and the actual number easily can beat that, but if you lower your expectations enough, then a modest result looks really good. So the 2 main reasons were given for the low job growth in August and September. And the first was really the Delta variant of the coronavirus was really holding back job seekers. And I can understand that. But the second was everyone would flock back to the job market in October after these enhanced unemployment benefits were going to roll off. Well, predictions were that we would see closer to 1 million new jobs that month. And it's all in the messaging. Listen just to one point of view, the Wall Street Journal. It said after 2 months of disappointment, the job market roared back to life, adding 531,000 jobs, while private payrolls jumped 604,000. Both were better than July and beat expectations. The unemployment dropped from 4.6 to 4.6 from 4.8. See, it's all about the messaging. Obviously, 500,000 new jobs is not 1 million, and we still have nearly 11 million job openings. Then again, it depends if you're a glass half full or a glass half empty type of person. Right now, we're in the latter camp and unconvinced that this situation in the jobs market is materially better. That's it for this month's SWAN Report. And I want to thank you for listening every month. Now, please remember that nothing that we talk about here is a recommendation specifically to you. If you have questions about your financial strategy and your financial plan, do give us a call at 850-380-9558. That's 850-380-9558. See you next month.